And welcome everybody, and thank you for the opportunity that we've got to maybe talk a little bit about Aferian this morning. So kind of 3 points I want to leave you with today. One is that we are very much positioned in a fast growing marketplace, that of streaming services, and that is driving our growth. Secondly, we're uniquely positioned to address that marketplace with our end-to-end service, our solutions, which we'll talk about, and how we're addressing those with customers. And thirdly, tell you a little bit about our 2025 strategy, how we're going to achieve that growth both organically and inorganically by addressing the marketplace that we're in today. So I think we're all aware that there really is a mass adoption of video streaming, and this video streaming services is growing quite dynamically. And not only is it growing, and we're all familiar with how it's growing with what we call the big three, or now the big four of Netflix, Hulu, Amazon, and Disney. But actually, if you look at the real growth and the fastest growth is in all the other services, and that's where media and content companies, broadcasters, and TV providers are bringing more and more of their content to market, monetizing that through streaming services. And you can see some analysis that's been done there, showing that significant growth. And COVID's only accelerated that. And not only now, it's not just the millennials that are actually watching all of this streaming service, it's the boomers and people like us who are really, fueling that growth, and that continues and is expected to double by 2025 to 167 billion. And I'll show you how our customers are using streaming services to address that opportunity. And what we're doing at Aferian is we're powering that growth in streaming. We're really focused on growth in this growing market. We're delivering an end-to-end solution, and we can bring streaming services to any screen, anywhere, and anytime. And really, we're focused on the consumer, but providing that as a B2B service to our customers, the content and media owners, enterprise, broadcasters, and TV providers. We deliver every day over 100 million streams to people worldwide to give them the video that they love, any screen, anytime, and anywhere. And we do that across a multitude of platforms. And we're very much uniquely positioned in this growing marketplace. As I said, we are growing in a growth market. We're not new to this marketplace. We've been in streaming services and streaming solutions, been a streaming pioneer for over 20 years. And we're well trusted in the industry to be able to deliver that. And our main goal is to take away some of this complexity. It is very complex, and I'll show you how we do that, but it's complex for our customers to actually address that. We take that away from them and make it simple for them to deliver those anywhere, anytime, and to any screen. Our customers are global, over 500 customers. As we said, media and content owners, broadcasters, and TV operators around the world. And we have a platform that gives us a unique opportunity, not to just address the traditional and new markets, but to go into some new verticals. We already service sports and enterprise, but also the opportunity to go into things like gaming, esports, and education. And again, we'll talk a bit about that as we go through this presentation. And finally, we've got a strong balance sheet able to help us address that market organically and inorganically, a good cash position, and access to additional cash to be able to execute on our strategy going forward. We did go through a bit of a rebrand. I think many of you will know us traditionally as Amino, but we think Aferian really reflects the extended marketplace and where we're really addressing the marketplace, or the streaming services marketplace. And we're able to do that through our operating brands of 24i, which offers our end-to-end technology platform, allows them to stream video to any screen, and through Amino, which provides streaming devices and also a SaaS device management platform, allowing more traditional operators and some new operators to actually get to market as well. And Amino is now providing all of these services. Aferian is now providing all of these services end-to-end to its customers.
In terms of us as a company, we are a global company, and we have revenues of between 85 and 90 million, as you see from the progressive analyst note forecast for this year. In terms of revenue by region, the majority of our revenue is in EMEA and in North America, where typically there are high ARPU customers consuming video, and we also have a significant chunk of our business in Latin America. We have 10 main offices around the world. We're headquartered in Cambridge, and we have large development centres in Hong Kong, in Amsterdam, and in Brno, with other satellite offices in Europe and in North America. So we are exposed to a global market and exposed to global customers.
And one of the things I did mention earlier, the fact that we have this streaming platform, these solutions, it means we can address a number of verticals. And we've highlighted some of the ones today that we address. And you can see there some of the customers within those verticals. And that creates, fantastic growth opportunity, because as we look across each of those verticals, we see a phenomenal growth opportunity ahead of us. New content owners, people like PureFlix and Broadway HD, bringing their content to market in a Netflix type solution. In sports, being able to monetize that more effectively. One we recently announced was the Canadian Hockey League, where they've got some back catalogs, some live content, and they wanted to get that direct to consumers, and we were able to help them do that. And then more traditional broadcasters, people we know in the UK like BBC or ITV, also want to bring their solutions via streaming directly to consumers. And you see a couple of our customers there, NPO, the BBC of the Netherlands, where we're providing effectively their iPlayer and their online solutions directly through streaming to their consumers as well. And then, of course, the more traditional TV providers, operators like T-Mobile, Slovak Telecom, and Delta in the Netherlands, and how we help them bring additional solutions and get their content directly to market through streaming services as well. And then finally, one of our other verticals, enterprise, we're able to deliver solutions such as digital signage, stadiums, and entertainment in events directly to consumers through some of our customers there as well. And again, just reflecting on, as Mark highlighted earlier, the fact that it is global in nature. You can see some of our customers and where they are around the world. So if you look at broadcasters, sports and content owners, I talked about the Canadian Hockey League, how they've brought their content to market via our solutions and via our platform. NPO, Post, Luxembourg, and KPN taking their content now onto smart TVs using our solutions. And then in the Caribbean, companies like Flow Sports through cable and wireless, bringing their content to customers who aren't even on their network. So allowing them new ways of monetizing that. And then on the bottom half, you see some traditional customers, as I said, people like T-Mobile and Deutsche Telekom, Slovak Telecom, delivering their more traditional solutions via streaming services to new customers in new ways, in new markets. And I'll talk a minute about Ufone, one of our customers that we deployed last year. And here, obviously, we talk about complexity and cost. And as you can see from the end-to-end services across the top there, you've got a lot of things to get right if you want to stream to multiple devices. Right through from the ingestion and the transcoding, through to authenticating, monetizing, and actually streaming that. And there's a lot in between. And we see and we know there are three main challenges for our customers. And that's this cost and complexity. So to deliver all of this, you've really got to have a lot of functionality and a lot of capability to do that. You've got to be fast to market. It's rapidly changing. You need new features. It's always been enhanced. And you need new revenue models to actually deliver that more effectively and do that quickly as well. And that's where we help our customers through our platform, which we invest in, giving them an off-the-shelf ability to deliver these services, the agility, speed to market, the ability to extend that with new features and new functionality, and then the monetization options. We're flexibly able to address that through all of the kind of monetization that you're probably familiar with and others as well. A good example of where we've delivered those three things, delivering, addressing cost and complexity, the monetization, and also the speed, is Ufone. Ufone We're an MVNO, a mobile virtual network operator. They launched in a few months with very few resources. We deliver that whole TV service for them across their network, over 100 live channels, and all the streaming services that go with it. And you can see the validation there from our customer, who basically got very quickly an end-to-end solution, including the streaming devices provided into the home as part of that as well for their customers.
Yeah, so just talk about our revenue model in terms of where we are as a business and how we charge for our platforms. Our customers are buying integrated video streaming services, and they're also buying, in the case of TV operators and enterprise, they're buying a streaming device which is powered by our software and integrated into that end-to-end platform. So how do we charge the likes of Ufone in terms of our revenue model? Well, clearly for an end-to-end video platform, there is a setup fee. As Donald mentioned earlier, it's a very quick time to market in terms of 5 months to market from nothing to launching a service in the case of Ufone. So there is a setup fee, and then there are ongoing recurring license charges as well as support and maintenance. And in the case of Ufone, there is a base fee plus additional features fees that is sold on a recurring basis. And then as the Ufone service grows, our revenue grows with the number of users, because there's also a per user charge on top. So we are focused on growing our recurring revenue, and you will see in our financials that we have been very successful in growing that element of our recurring revenue as we grow as a business. In addition to that, we also sell our streaming devices, and those are sold on a per device basis, and they come bundled with our operating system software on that device, which is pre-integrated, as I said, to the end-to-end streaming platform that Ufone has or anybody has. So we integrate to multiple platforms, and that is sold on a per device basis with a maintenance charge, which is on a recurring basis, as well as our software as a service device management platform, which is also sold on a recurring per device basis. So we have elements of one-off revenue in terms of per device, where we've bundled the software with the hardware, and we also sell a significant amount of recurring revenue moving forwards.
So why invest in Aferian, and obviously why now? Well, we believe it gives our investors the opportunity to invest in increasingly predictable software-driven growth and returns. We're not new to this marketplace. We've got 20 years of streaming media experience, but we've got a really good skill set, a platform now, and the right relationships to be able to deliver that. And the market is now, significantly growing. We are uniquely positioned. Some of the things we've done over the last 3 years mean that, we've able to add to our solutions and complement those, but we're able to sort of navigate our customers through what's a very complex environment, and to do that effectively and efficiently. And our platform, the approach that we take, not only is able to address our more traditional customers and some of the new entrants, but allows us to enter into some new verticals. And by addressing this through a platform, through investment in a platform, we're able to do that more through our recurring revenues and get that additional predictability into the business. I'll talk a little bit about our strategy. We announced earlier this year our 2025 strategy. Our priorities are about focusing on the consumer and customer-centric products, but delivering that in a B2B way to our customers, who are the content and media owners, broadcasters, and TV providers. But what we want to do is give consumers the things that they really want: that choice, convenience, and usability. And we, focused on making it easy for people to stream the video they love, any screen, anywhere, anytime. And we've set ourselves a set of goals, financial goals, to triple revenues by the end of 2025, most of that coming from software, and within that software, most of that being recurring in nature. And you can see here, we've tried to map out our competitive landscape. I mean, we are unique in that we are an end-to-end player. I think almost uniquely, with the exception of maybe TiVo in North America, who address a slightly different segment of the market from us. But we really focus in 3 areas: apps, platforms, and streaming devices. And that we particularly got a lot of cross-fertilization across the platform, the applications, and again, unique in the ability to be able to deliver, one or the other, and both of those. And once we've sold with some of those services, is then to extend further into the customer's network or into their solution as well, and able to help them deliver that end-to-end solution. And even streaming devices, I mean, I think what's underappreciated is we've always been in streaming devices. Unlike some of the other brands you see there, like Technical or Sagem and Keon, they were traditionally, and CommScope, traditionally cable and satellite providers. You know, cable and satellite is moving all towards streaming services. You've probably seen that in the UK, you know, that Sky has gone from being a satellite provider to now aiming to provide all of their solution across streaming and streaming devices. And that's the space that we've always been in. So unique in that respect that streaming services, you know, small IP-based devices is where we've always been in that marketplace, and where we've always been focused on our capability and our technology. If we go to the next slide, we've tried to highlight here clearly, you know, a lot of that growth needs to come from some M&A activity. And what we've tried to sort of highlight here is the M&A landscape that we're addressing and where we see the opportunity. And we've kind of mapped out here to make it a bit more obvious, but clearly we've got gaps that we'd like to fill, both from technology, capability, and market point of view. We've got some areas where we like to consolidate our position and maybe get a bit stronger, grow a customer base in those areas. And we've got some areas where today we may partner or work with others where we'd like to get, you know, more involved and extend our capabilities in those areas. And we've worked on this pipeline and this capability over a number of years to be clear where the opportunities are. And we feel that over the next period, there's going to be a great opportunity for us to address that. Some of you may be familiar, we did do a small acquisition just a few months ago, which actually helped us address some of the elements of this and helped us consolidate our position in streaming services as well.
So in terms of where we are going as a business in terms of our strategy, you can quite clearly see that we are investing in end-to-end video streaming services to drive our recurring revenue growth. And you can see that in our financial progress. So we announced our H1 numbers in July this year, and we'll give you a quick snapshot of those now. So you can see total group revenue up 19%. And we can see in terms of our recurring revenue, which is a number we focus very highly on, given that we are selling recurring services, that was up 37% in the period. We've also got a good EBITDA margin of over 20% and growing, and that EBITDA was up 17% in the period as well. In terms of our business, we do aim to generate cash, and we invest that cash both back in the business in terms of investment in our platforms, M&A, but also we return money to shareholders. And we were pleased to announce a dividend of 1 pence per share for the half, in line with our full year policy of paying between 33 and 50% of adjusted EPS to shareholders. We also raised £9.4 million in the first half. That was as a result of an unfortunately aborted acquisition, but we retained those funds to fund our M&A strategy going forwards. And these are the KPIs that we as a management team monitor and focus on. So our total revenue, as we mentioned earlier. We also look at our software and services revenue as a percentage of our total revenue, and that was about 22% in the period. You see that the growth was not as fast as the overall growth, as in the software and services platforms. We focused very much on growing recurring revenue to give us more visibility in terms of the future. And you can see that there with the growth up to 13.8 million. As Don mentioned also, we have a target of 70% of our software and services revenue being recurring. And we can see that we've increased that now to 56% in the period. Our adjusted EBITDA, you can see, is obviously a key focus because that drives our cash flow. And we had adjusted operating cash flow of 4 million in the period, which was impacted by some one-off working capital items, which we expect to unwind in the second half of the year.
So in summary, you know, hopefully you can see, particularly from the results, that our strategy is delivering results for us with ARR, revenues and EBITDA increasing as we planned. And we've got a very clear set of targets for our 2025 strategy, you know, in very much a growing market. Our focus is around recurring revenue, software and services, and actually strengthening through that the relationships and the position that we have in the marketplace. And what we've seen is over the period is that our visibility as a business is the best it's ever been. You know, the more predictable nature of our revenues and actually some of the changes that we've made mean that, you know, not only have we got good visibility through this year, but good visibility into next year and beyond. And we believe, you know, a good opportunity to grow both organically and inorganically going forward and driving towards our 2025 goals.
You've been winning contracts in Asia, for instance, PCCW Hong Kong. What's the growth strategy in that region?
The growth strategy is very simple. It's to extend, you know, our services and solutions into that marketplace. PCCW is a really interesting one where, you know, we've gone in there and they've seen the value in our software, streaming services software. So the recent one we announced was about how we're helping them with Android TV to deliver services, including Netflix and Disney and all of those. And we're doing it uniquely through, we license our software to a device manufacturer, a Chinese ODM, who provides the streaming device to them. We don't provide the streaming device, but then they also license our software from us and our SaaS management platform. So as they're able to manage the service, the quality service and the solution to their end customers. So a really exciting customer for us. We've also announced some other Android solutions, I think in Japan, currently quite small, but you know, it's an interesting marketplace and where we see a good growth. And again, they're really embracing streaming services going forward, and we believe they'll, you know, Asia will provide, you know, a good and healthy marketplace for us. And it does help that we've got presence there. We do have an operation in Hong Kong, and we've got teams, you know, in the Asian marketplace as well.
Could you provide more detail with regards to your marketing strategy in acquiring more customers to reach your 2025 objectives?
I think if you look at our marketing strategy, you'll see it's very much about, you know, addressing the needs of these customers. And as I said, it's about, you know, appealing to more and more of them are struggling to be able to keep up with the fast-paced change in nature of the streaming market. You know, how you bring those new features and new functionality. A lot of our marketing has certainly moved online. I think for probably investors like some of the people on here today, if you want to keep up with some of that, one of the best places for you is really through our LinkedIn presence. You'll be able to see some of the things that we're doing on there, and you'll get an idea of how we're approaching the marketplace. But we know our market well. We are using a lot of digital channels to make sure that where there's new entrants coming to market or people looking for new ways to do that, we're getting in front of them as effectively and as efficiently as possible. And we've certainly seen with our digital presence, which we had started accelerating pre-COVID, and actually we did a much better job during COVID, we've seen a really healthy uptick in pipeline and opportunity going forward, because we are in a market where everybody wants to get their content and their solutions and their video to the customers as efficiently and as effectively as possible.
I think I'll just add to that, our strategy that we set out so when we did the acquisition of 24i as well was very much based on the fact that the customer focuses on the consumer user experience, and therefore you see that our customer wins over the last 2 years have really been focused on that consumer and customer user experience, and that then drags through the back-end platforms and the streaming devices with it as well. So that's where we've had the most amount of new customer wins.
And that's also how we extend our services into existing customers. So one of the things we're really proud of is the growth in an existing customer base. They'll start off, PureFlix is a good example, where we did some initial UX applications. So you got a little app and we did that. And then as we've gone on, we've taken more and more of the solution, provide more and more of the back end and the platform for them. And that's what we're doing for all of our customers.
Chris has asked, I can see why end-to-end solutions are useful for small customers, but why do larger customers need this? Or do they more often choose individual point solutions from different providers?
So traditionally, larger customers do this by themselves. But more recently, customers have started to, as we talked about, cost, complexity, features, functionality, and agility, they start to struggle with that. As new platforms come on, Roku's a good one. Been able to address a lot of the smart TVs, for example. They don't have the capability. So initially they start by doing that and say, hey, could you help us? And we've seen larger customers, people at KPN, say, would you address Samsung and LG smart screens for us, smart TVs for us? We'll start doing that. But we're seeing more and more of that being outsourced, and even with bigger operators. And we see that as a trend that's ongoing because, again, it takes a lot of resources. I mean, Netflix, invested billions to build, obviously, their platform. If you look at Disney Plus, likewise, they acquired actually one of our 24 Eyes competitors called BAMTech. They acquired them to actually go and build that in-house. We see fewer people doing that and more people starting to outsource more of that solution because that's the fastest way to keep up with the marketplace and the opportunity.
What's the expected split between organic and acquired growth to reach the 2025 target? And do you expect to raise more equity to fund those acquisitions?
So yes, in terms of the organic growth, we're seeing in terms of at the moment, the organic growth in recurring revenue being about 15%. And our organic growth rates overall between sort of 10 and 15% in our software and services. It'll be a bit smaller in the streaming devices business, but we are seeing price increases and cost increases in terms of inflation to show growth in that business as well. There will be a significant element of the 2025 targets delivered by M&A. And we do have a financing strategy in place that we're putting in place to both use equity and a larger element of debt in certainly initial acquisitions, which will allow us to increase the quality of our revenues, increase the quality of our earnings, and increase the share price before we then raise more equity. So we're not looking to dilute shareholders. We've very much got a financial strategy in place to increase the share price.
Please could you talk about the other end-to-end provider, TiVo? You mentioned that they were different in their focus, but it would be good to understand that a little bit more.
Yeah, TiVo is very much a North American focused kind of tier 1, tier 2 provider. We did come up against them recently when we were trying to do the Mobi TV acquisition. And, they're a very strong company, a strong brand, but we rarely actually come up head to head on opportunities. They're really a much more complex, heavier solution, really aimed at the larger tier 1 operators. So, we can compare ourselves, in fact, because they also provide, the end-to-end solution, including devices, and that's why we put them in there. But we rarely come up against them, and if we were, it would be in the North American marketplace.
On the aborted acquisition, could you outline why it failed to consummate, please, and what sort of EV/EBITDA valuations we are looking at?
Really, we ended up bidding against TiVo, and they had much deeper pockets. And we knew how far we could go. We had a very clear business model. We knew what we could achieve, and we weren't going to achieve those numbers. So we were quite disciplined, as we always have been, in making sure that we were going to get the right value. And if somebody else wants to pay more than that, then we just weren't able to go after that. It was an excellent opportunity. We would have addressed it in a different way to the way that TiVo's addressed it, and I think we'd been very effective. But they had much deeper pockets and had some other reasons for doing that.
Yeah, it was a slightly unique situation in that the business was being sold out of Chapter 11, but it was being sold out of Chapter 11 with guaranteed increases in revenues, volumes, and guaranteed customer contract terms. And I think one of the most interesting things about that process was, as we went in as a bidder, we were able to, in effect, present the solutions that we have as Aferian to the Mobi TV customer base, because we obviously wanted to make sure that their customers were happy with us as an acquirer. So we were able to present to about 110 different service providers in the States as part of that process. So it really raised our profile as Aferian in the States. And one of my internal wins, if you like, is that I claim that I've got a better cost per lead my acquisition costs, the aborted acquisition costs of Moby TV than our marketing team, but that's just a little bit of needle we have internally. In terms of the EV on that business, we were looking at it as a business that was in a turnaround phase, and we would have had to invest in an additional $5 to $10 million to turn that business around. But with the guaranteed revenues, we were looking at $40 million recurring revenue in 3 years' time. So the return on investment would have been very significant.
Given this is still a relatively new market for many of your customers, are they actually making much or any money from their OTT services? I'm trying to get a sense of the sustainability of the smaller size customers.
Yeah, I can assure you they're making money. You know, and actually COVID sort of accelerated that. So if we look at some of our customers, we had one or two that we launched actually either in COVID or just before COVID. And our view was that their business plans got accelerated by about 3 years. So taking away some of that investment phase for them, because suddenly they ramped their revenues, and they've been able to sustain good revenues as well. So, and you know, we see that more and more investment in that side, and less investment in the more traditional. You know, like we said, a lot of the operators, they're not investing in their cable or their satellite networks, but they will invest in getting their services, the streaming services in place going forward.
You talked about the big four: Amazon, Hulu, Netflix, and Disney. Do you think that it's likely to become a big five, or is the market now stabilising with those players as the leaders?
Probably should have crystal ball. Will there be a big five or a big six or a big seven? There may be. But what we do know is there's a proliferation of other solutions coming. So, you know, a little while ago, people were taking on one additional service. It was a Netflix, or in the US, it was a Hulu or a YouTube. But today, people are taking 5, 6, 7, 8 different services. You know, one of the opportunities we have is through our solutions to more traditional operators that help them aggregate those streaming services. So I mentioned PCCW, I mentioned our Japanese customer. That's what they're doing. So we are helping them provide a whole bunch of new services, but also Netflix, Disney, Hulu in those marketplaces, combined with a more traditional live content as well. You know, we see more and more people bring content to market. And if you look at the market stats, of that 167 billion by 2025, about 55–60% of that comes from the non-big companies. So a lot of new players, a lot of existing players taking content in new ways. And that's the market that we address.
So Ian has asked, can you talk about revenue visibility? Is there a long pipeline of new operators being rolled out?
Visibility is the best we've ever had, because traditionally visibility used to be one of our big challenges. So if you look at our software business, it's far more predictable. We know where it's coming from, and with the nature of recurrent revenue means that the majority of it, we know where it's coming from. And even our streaming device business, you know, more of that coming from software. A lot of our streaming device business, it's not recurring, but it's very much reoccurring. And I think you've probably all heard about all these supply chain challenges in the marketplace. Well, these have been around for a while. We've been addressing those. The good thing about that for us is that we've worked with our customers to say to them, you know, some silicon now is in 12 months lead time. So if you really want to be ensure that you've got, you know, your devices in place and the capability you need to grow your business and to maintain your business, we'd like you to help give us more visibility. So we are seeing much better visibility even in the device business, well into next year now. So that certainly helps us and helps us, you know, address the opportunity.
I think the question was also partly aimed at the wins in new customers, and as I mentioned earlier, the new customer wins tend to come through the marketing channel of the user experience, and I think the fact that we are winning customers in the period and seeing our recurring revenue grow is coming from both existing customers and new customers. So whilst we don't give any numbers, you can see that the growth that we are showing is driving that, and we are confident that growth is going to continue, and that pipeline is there because the user experience and the streaming market really is driving that growth.
The revenue forecast for 2025 was 175 million software and 75 hardware. Will the hardware with the change in technology not become redundant?
No.
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 Well, I was nodding. I think that's a good question, but no.
And I think this is where there's maybe an understanding, and we've been very clear of saying that these are streaming devices, and that's what we've always done. So if you look at the traditional Aferian amino business, it was in those devices. If you look at what we refer to as set-top boxes, it's normally cable and satellite. That's where the market's been. That is in decline. Cable and satellite is all moving to IP, to streaming. And those are the devices that we provide. So we're fortunate that is where we've been. We've always been in small little streaming devices. We've never been in a big cable box that had hard disk drives and tuners and all sorts of stuff in there. And if you even think about what you've got at home, Sky or your old Sky box or your old BT box, they were great big things with hard drives that got a little bit warm, so they had fans in them. We've always been in these little hockey puck streaming devices that have a chipset, and everything is done through software. And that's why, if you look at us, we don't really have any hardware engineers. We're all about the software, because it's a commodity device, but it's a very highly integrated, complex piece of software that simplifies it for the end consumer and for our customers.
Gaming and e-gaming you mentioned as opportunities, but these organisations are already well set up for streaming and video delivery. What is it that you can add to their platforms?
Well, it's really about, I think we'll see over a period is people who traditionally maybe deliver TV and content will start to also deliver some of this, these gaming and e-gaming solutions. I don't know if you're familiar, but Netflix have already announced that they will be delivering that, and I think there'll be a requirement for others to actually deliver that as well. And that's just one of the verticals. We talked about education. Even during COVID, we had a number of opportunities start to come to us around delivering some of the education, those kind of things. So that's things we're looking at and investing in the platform and how we can actually deliver some of these solutions going forward. The point is that our solution is a platform that can deliver different verticals. It's not just restricted to TV as we know it. It's actually an opportunity for a whole bunch of other opportunities as well.
Are you materially exposed to foreign exchange moves, and do you hedge this at all?
So the majority of our sort of, if you like, revenues and costs are natural hedges. Our revenues, we show them in US dollars, and we have a significant amount of US dollar revenue, and that typically is, we're not exposed because we also have US dollar cost in terms of our people in Hong Kong, which is linked to the US dollar, but also in terms of our materials and our devices, which is all sold at a US dollar price. In terms of our operations in Europe, we have people in Europe, and we also have a significant proportion of our revenues in euros, as you can see from our breakdown. So we have natural hedges within our business. That means that we don't need to hedge our bottom line from an operational perspective. Clearly, the biggest exposure we really have to you as investors is that we generate our profits in dollars. We are listed in the UK, so we will pay our portion of our profits out in dollars, but that's probably the biggest exposure to you as investors, because our dividend ultimately is a dollar dividend.
Please could you talk through the adjusting operating cash flow in more detail?
Yes, for the half. So we in the half we secured $4 million worth of adjusted operating cash flow, and that really is the cash flow generated by our operations. And I mentioned earlier that we had some working capital outflows in the half. Now, if you look at our business and the way we monetize our services at the moment, we are continuing to grow our revenues in terms of recurring revenues, but 80% of our revenues are coming from our devices business. And that does have one-off working capital impacts depending on the timing of when those devices are sold and who those devices are sold to. So in the half, we had a different profile of revenue sold to different customers at the end of that half compared to the previous half. Therefore, we had a working capital outflow. We do expect, looking at our backlog and order book in the second half, that will unwind as we sell to different customers with different working capital profiles.
Was the head-to-head with TiVo atypical, or will you likely be up against them or other gorillas in other M&A targets? Can your pipeline get to 2025 targets if you get outbid? And or does this mean you will only be able to buy lower quality businesses the big boys don't covet?
That's a really good question. I think that particular opportunity was a bit unique because TiVo had some particular challenges in their platform, and that by acquiring that asset, it managed to allow them to make changes they needed to make to address other, and this is my opinion, and this isn't a fact, but other maybe operational issues. So I think we were unique. We were very unlucky it was them. I think anybody else that had been in there, we would have got that asset and we'd be sort of crowing about it now. But as Mark said, it wasn't wasted. It was a good opportunity. Are there any other? So interestingly, I mean, I think our biggest challenge is probably with the likes of private equity. You know, we have lost out in some opportunities in the past, and we've lost out of them because we didn't really have the funding in place to be able to, you know, to the assured execution. And so we were a higher risk than, say, others. So that's one of the things Mark talked about. You know, we've looked at putting the right capital structure in place so that we can address those more effectively. And the other reason, I mean, why have we put that strategy out there? Of course, it's important. We want to tell you, the investors, it's actually really important that our targets know that we have an ambitious strategy. And we're not acquiring assets that we just want to take over and shut down or asset strip. We're actually acquiring assets that want to come on a journey with us, and a journey of growth, who really get excited about making customers happy, about driving growth in business with customers, building relationships. Because that's what, you know, we give you all this stuff about our financial stuff. What really gets us excited is when we're with customers, we're building new streaming services. You know, our employees get really excited about seeing their services out in the marketplace, being able to go and get their family to be able to use those. And so we're acquiring things. We want people that are like-minded. Now, Nordia, I know for a fact that we actually acquired that asset below the cost that others were prepared to bid, because the Nordia team wanted to be part of this, you know, the platform, they were part of the solution, and they wanted to build and extend on the customer base. So, you know, the strategy out there is, you know, we want to tell you about it because we know we're going to have to invest, and we want our customers to benefit, or sorry, our shareholders to really benefit from that. But also, as we're out in the market trying to get, you know, build our asset base, we want to do that with like-minded people that want to come on the journey with us as well.
For a complete newcomer, could you outline the geography of your customer base and whether that is likely to change very much as you expand the company?
Well, I think we tried to do that on the previous slides, in terms of we had one slide on geography by customer. So we have, you know, 40% of our revenues in Europe, 38% I think was in the United States, and 16% in Latin America. So we have a really good exposure to those two big markets, where we're seeing streaming services with high ARPU per customer in Europe and in North America, and we are very much focused on those two markets. As Don mentioned, there is still growth to be had in Asia, in particular in our investments we've made in our customers in Japan, but we really do see the markets in North America and Europe as the ones where we are seeing the fastest growth at the moment.
Just to highlight, you know, the US market is actually twice the size of the rest of the world combined, so it is quite an important market for us.
Does growth in ARR mainly rely on new customer wins, or is it also driven by increased subscriber bases within your existing customers?
This year we have had new customer wins, but in terms of what does it rely on, it relies on both new customer wins, also user growth in customers. So we've seen Uphone, as we mentioned earlier, there is an element of that linked to subscriber growth, so putting in new services and then expanding. The same with the likes of Delta, who have been expanding significantly, but also, as Don mentioned earlier, with the likes of PureFlix, from us landing and expanding our product base. So we landed in PureFlix for the user experience, and now they're taking much more of our services in our platform. And that was the marketing strategy we set out when we acquired the 24i business was to land and expand with the user experience and then pull through our platform and our streaming devices into new customers, and we can see that's been working.
You sell to a very large number of relatively small customers. How do you prioritise technology development? Do they all want the same things, or is there a wide range of different needs?
Well, we invest in our platform, and that is the key to this. Particularly when you look at our front end, the sort of the application user experience, you've seen the increase in ARR. A lot of that's come from the fact that traditionally that was all delivered through a bit of a platform, but also more of that being professional services. Our goal when we acquired 24i was to actually productize that. So you see more of that been productized. Now, of course, we build some of that off of what are the needs of the customers, and we've got good visibility of what customers want, and we build that into roadmaps, into platform, and it's clearly our direction is to build that platform so that all customers can get the opportunity to get access to those features and that functionality as we develop it.
Given your US exposure and desire to raise Aferian's profile, have you considered a dual stock market listing in the US?
Have we considered it? Yes, I guess we've sort of discussed it, and that's something I guess we talk about at the board. He's certainly looking forward. We have got good exposure there. It could be something. I think we need to be a bit bigger than we are, and as we execute in the strategy, that becomes more of an opportunity for us going forward.
Yeah, I think Donald's right. It's the size piece that will be something that would be more available to us once we grew. And you are seeing companies come to market in the US, such as Kaltura, who IPO'd recently at very good valuations, who have similar technology to us. So that is definitely an opportunity. But as Donald mentioned, due to our size, not something we've currently discussed.
Have you lost any clients to TiVo in the US or internationally?
No. Never. Well, listen, thank you, everybody. Thank you for listening. Thanks for the questions. Great questions. Really enjoyed those. Thought-provoking, some of them. I think hopefully we've shown you that the Aferian, the group, we're really addressing a high growth, a really solid marketplace that's quite exciting. It's quite exciting for our customers, and we're helping address their needs in that. So hopefully we'd hope some of you will come on that journey with us, and hope you enjoyed the presentation. And feel free via Emily or directly or whatever to send any questions or queries you might have. So thank you.
Thank you, everyone.